Okay, so exchange rates. So you have I've posted some short videos that talk about the gold standard. Um, and as we've seen in the introduction, this the gold standard was sort of the um, spontaneously emerging standard of the globalized economy, globalized Western economy mostly in the late 19th century up until World War One. Now, although it was called the gold standard, it was not sort of an international standard. Okay, there was no international agreement establishing the gold standard. So the basis for the gold standard was really the domestic rules of the central countries in the system, like the United Kingdom. So gold was convertible to UK pound sterling, but that was because of the domestic economic policy of the United Kingdom. So, the Bank of England, when they issued a banknote of £1, they needed to have in their reserves the value of that £1 banknote in gold. Why? Because if you wanted, you could go to the Bank of England and trade that banknote or that set of banknotes for gold. Now, so at the time, there was free import and free export of gold for monetary purposes. So, you could be an individual and, you go to the bank and you exchange your money for gold, and then you can export that gold to pay, for imports of, say, a new shoemaking machine from a US manufacturer. So the system was really one where the rules of the game were sort of set by the central banks of the key players in the system. Now, with World War One, the system was shaken because all of a sudden states had to increase money supply. They had to pay for the war effort. Now, this meant issuing more paper money, up to a point where very early on, the amount of paper money out there was much larger than the amount of gold reserves that the Bank of England had. So, if the value outstanding is higher than the value of your reserves, then convertibility is merely fictional. So the gold standard was, for all purposes, interrupted. Plus, because there was a war going on, it was not safe to move gold around in international trade. There was the German blockade with the U-boats and war in continental Europe and other parts of the world. So it was not viable to export and import gold. So the system just broke down. Now, following the war, the United Kingdom, believing itself to be still the sort of central empire and one of the winners of the war, they try to resurrect a more limited version of the gold standard, one where only governments, so central banks basically, could ask for the convertibility of balances in say, United Kingdom pound sterling for gold. So you could only have convertibility not for private citizens, only for monetary purposes. That is to say, for monetary agents, that is, central bankers. The problem was that between 1919 and 1925, because the United Kingdom had a huge war debt, the pound floated against the dollar, and the dollar was the only currency that was still convertible to gold at a fixed value, a par value. So the British tried to return to the gold standard in 1925, but they fixed a value, a convertibility value, pound to gold, that was not sustainable. The pound was overvalued in the sense that the British economy was not producing enough to support the value of the pound, such a high value of the pound in terms of gold. So this led to it being abandoned by the end of 1920s. And then in the 1930s, as we've seen, the interwar period was one where, states, in order to make their exports more attractive, they devalued their currency. That is to say, they made the value of that currency versus gold or versus other currencies lower. If you can now buy more goods from Patria using Xantria's dollars, then imports from Patria will probably increase because, your Xantria dollars may now purchase more imports. But if Xantria now devalues its own currency, then this is going to annul, to cancel the effect of the first devaluation. So there was, countries were adopting these devaluatory policies. Other countries like Nazi Germany were using discriminatory exchange rates. For instance, if you bought, say, a shoemaking machine from Romania or Hungary or another of the friendly powers to Nazi Germany, you would have a better exchange rate for your Reichsmarks than if you bought from, say, France. So this was a measure that distorted trade, because instead of buying, from the most cost-effective producer, you would have these currency restrictions making you buy from a preferred trading partner of the country, although they were not, the best suppliers of these machines, the most efficient suppliers of these machines. So, and ultimately, Nazi Germany used its exchange rate policy as part of its policy to extend economic and to a large extent also political control to a number of countries that then during World War II became its political satellites. Now, in 1934, the United States did return to the gold standard, which by now was ultimately just a gold dollar standard, at a fixed par value. So an ounce of gold would be valued at $35. So if you had $35, if you were a central bank, not a private individual, but if you were a central bank and you had $35, you could convert that balance into gold. Now, this made the US dollar, a very attractive currency. It's good for a country to have US dollars because it's as good as gold in the sense that, if I have a balance, that is to say, if I have dollar reserves, I can just convert them into gold at this fixed exchange rate. So, dollar is a safe bet in the sense that that it will be convertible into gold. So you don't need to have gold, as long as you have US dollars in your accounts, which sort of created the basis for the Bretton Woods system. Now, the Bretton Woods system was one where, and I'll finish with that, where the dollar is the central element. So the dollar is convertible to gold at the same value of an ounce of gold, a troy ounce of gold equals $35. Now, other currencies were not directly convertible into gold. So, if you had British pounds and you went to the Bank of England, if you are the Bank of France and you have British pounds, you go to the Bank of England, the Bank of England will not give you gold. But they might give you dollars, and if they give you dollars, then you can convert dollars into gold. So, you can convert British pounds into dollars, and then you can convert dollars into gold. But this depended on the willingness of the United States to maintain convertibility at the par value of $35 to an ounce of gold. And that's what was upset in the early 1970s. But I will, and you have a nice video showing the Nixon speech when he said that, that the United States was abandoning dollar gold convertibility. And that was the end of the Bretton Woods system as it was originally created. Why is this important? Well, it's a bit like the gold standard that, every once in a while, whenever you have times of greater currency instability, some voices will say, well, maybe you should go back to the old times of the gold standard. which by now, by the way, under IMF rules could not be done, or that we should go back to the old dollar gold standard, to the old Bretton Woods system, which again, because gold cannot be used for monetary purposes in the IMF, under current rules is also not allowed. Okay, so as we've seen, we've had the dollar standard, the gold standard, by the end of the 19th century, beginning of the 20th century. World War I disrupted trade and disrupted also this international informal monetary system. The period between the two world wars was one of currency instability. Attempts to reinstate the gold standard that failed because Britain was no longer able to sustain the comfortability of British pound sterling balances held by non-residents with gold. And so ultimately only the United States was in condition to restart the gold standard by making dollars convertible into gold as of 1934. Now, following World War II, again, the United States was the only country that had a balance of payments and a reserve position that allowed it to retain this the convertibility of dollar to gold. So the Bretton Woods system was basically supported by the US dollar. And as I mentioned, so even if you had another currency, any other currency, you could still ensure a direct value or an indirect value between your currency and gold, since your currency could be exchanged with dollars, and then dollars could be exchanged with gold. Okay, so that's the indirect conversion system that we had following World War II. Okay, now in this system, members were required to set a par value, that is a fixed value between their currency and the US dollar, and through that with gold. So that's the sort of the central rate or the par value of a currency. Now, obviously there are changes to the value of currencies. You know, if a country has high inflation and the US has low inflation, then your currency is going to devalue vis-a-vis the dollar. That is to say, you know, a year from now, because of inflation, your currency is not worth as many dollars as it was at the beginning of the year. So inflation tends to change the value of currencies. Now, this meant that throughout time, then currencies would float and they would not be at exactly the par value. Now, the Bretton Woods system required that members intervene in the market by buying or selling exchange currencies in order to sustain the par value of their currency. And they were only allowed to float, that is, on a day-to-day basis. The value could only float above or below the central par rate by 1%. So minimum variations in terms of exchange rates. That is why it was called a system of stable exchange rates. And if you think about, 1% variation, obviously that is, an insignificant factor in terms of, if you have to decide if you're going to buy something, that has a price of $500, that your currency is not going to be devalued vis-a-vis the US dollars in more than 1%. So you know that you have a system of stable prices as well in terms of international trade. Now, although the system operated as one of stable exchange rates, it was not a system of fixed exchange rates. If you think, for instance, of the euro, on the basis of the euro, when the euro was created, there was a fixed exchange rate system. That is to say, for instance, Portuguese escudos would be traded for euros at a fixed rate of 200 escudos, 0.481 or something like that per euro. So that's a fixed exchange rate system. It doesn't float up or down. In practice, the system did, now turning back to the Bretton Woods system, it did operate as a system of, almost fixed exchange rates. There are a few exceptions, and I note those exceptions here. in this slide. Okay, so the problems that occurred in the system later on resulted from the fact that in order to sustain the system, it required the US to have trade deficits with other countries. Every year there's an increase in trade, 3% growth in trade, etc. And the more trade there is, then the more you need to have money, brought into the world economy, because if the money supply does not grow at least at the same rate as trade, then you're going to have deflationary pressures in terms of international prices. That is to say, you have a higher value of trade, but a lesser stock of money in order to make the payments for that increased trade. So the system really relied for its growth on the ability of the United States to continue to incur trade deficits. Now, the problem with the trade deficit is that it only lasts as long as other countries are willing to accept. A trade deficit only lasts as long as other countries are willing to accept your currency, in this case, the United States dollar. And since the system implied that dollars were convertible into gold, this was a promise made by the United States before the international community in the IMF Articles of Agreement. The more dollar balances, that is, the difference between what you owe and what you are owed, between assets and liabilities, the more dollars you have in the hands of foreign central banks, then the less likely it is that the United States would be able to actually convert those balances into gold. So this creates a self-fulfilling prophecy. After a while, there are far too many US dollars held by central banks in other countries. Then there is gold in order to ensure that that US can convert those US dollars held by foreign central banks into gold. So and at the time there was another instance that was sort of US were very criticized, particularly by France. France had President Charles de Gaulle, a very strong nationalist leader, and he said, we should not allow this because the United States has what he called an undue privilege, simply because they issue their currency as US dollars, and the rest of the world seems to be willing to accept US dollars and to hold US dollars as reserves. The US is able to continue to sustain these long-term trade deficits with the rest of the world. And so this is an unfair privilege in a sense that comes from having the central currency in international financial affairs. And as we're going to see, this issue of the central role of the US dollar is one that persists to our days. And some had hoped that the euro would eventually become sort of an alternative to the US dollar, thus creating also an alternative to international monetary predominance of the United States. Okay, so there was a temporary arrangement at the time, but this did not last long. So I'm not going to dwell much on it. And what happened was that, the system simply collapsed. The US in 1971, President Nixon took the decision to end convertibility. There was an attempt to restore convertibility at a lower par value for the dollar versus the gold, but ultimately it collapsed in 1973. And so we entered an age where you had these rules in place, but actually they were not really being applied. So the Articles of Agreement created this legal challenge. We have all these rules in place, but they're not really being followed anymore. So we had to reform the IMF. Now, the question then was, okay, in which direction should the IMF go? Now, the US attempted to promote this idea of symmetry, that adjustment to balance of payments, in case of balance of payments and devaluation problems, should be done by both sides of the equation. That is, both surplus as well as deficit countries. And so that was one of the ideas. However, there was no political will, as you see here, to go back to a system of stable but adjustable um, exchange rates. So free floating became the rule. Plus, in the early 1970s and in the late 1970s, we had the first and second oil shocks because of the tremendous increase in the price of oil. This created a lot of inflation in industrialized countries, and so with high inflation, it was no longer sustainable to have a system of sort of very stable exchange rates, because countries had very different rates of inflation, and so the system was ultimately simply abandoned, and so we entered into a new age, which is ultimately what we still have today. So okay, so the Bretton Woods system, and with its central par values, the rules on maximum allowed variations of 1% above and below par value, the duty to intervene in order to secure that your currency kept within that very narrow margin, all of that was swept away in the 1978 amendment of the IMF. Now, because of this, obviously, the question arose, what then for the IMF? What is the IMF then to do? Now, there were a number of agreements. So, as I said, to revise the IMF articles of agreement, and the IMF substantially modified its powers. So, before the Bretton Woods, during the Bretton Woods system, before the 1978 revision, the IMF had all these powers. So, IMF member states had relinquished, a significant part of their monetary sovereignty to the IMF. They had undertaken to ensure convertibility and those par values, and to keep exchange rates within those par values. And now, all of that was obliterated. So the IMF's powers were substantially reduced. And so, as you can see, it basically became an area for the IMF to do economic follow-up of what is going on in terms of exchange rates in a system of flexible, fluctuating exchange rates. So the IMF has these information gathering powers, as you can see, Article 8, paragraph 5 of the Articles of Agreement. So they collect information, they collect statistics on international monetary problems, but they no longer have this direct element of ensuring stable exchange rates. Now, one of the key provisions of the Articles of Agreement of the IMF, one that you really have to read, is Article 4. Now, Article 4 dealt with the exchange rate arrangements. Now, those are gone, as we know, with the Second Amendment. And so now members may, if they want, establish a number of different exchange arrangements. Okay, so they can create a system of fixed or stable exchange rates, but they can no longer use gold as the central denominator. So they have to value their currency in terms of special drawing rights or some other common denominator, but not gold. So gold is excluded from performing a monetary role. On the other hand, you can have these cooperative arrangements like the European monetary system, and you can have any other system that you want other than using gold. So complete flexibility for IMF members to adopt the exchange rate arrangements they wish. And so ultimately what we have is the value of, say, the euro or the British pound today is determined by the market, by the demand and supply of British pounds and all the other currencies, US dollars, euro, etc. Okay, so what about obligations? Well, as you can see, there are a number of obligations in Article 4, paragraph 1, but these are really much more of a program in order to what would be desirable in terms of trade and monetary policy, rather than any specific directed obligation. So as you can see, they should try to direct their economic and financial policies in a way that is conducive to the objectives of sustaining economic growth with price stability, to try and promote that stability by attending to their domestic economies and the financial conditions. They are still under an obligation to avoid manipulating the exchange rate. So this is an area where you still have hard law, so binding obligations in this area. And then this very broad commitment to follow exchange, so that they cannot follow exchange policies that are incompatible with undertakings under Article 4. Okay, so they're not allowed to do that, but other than the places where you have rules, then the question is, how do you enforce this obligation? Well, as you can see, the main mechanism is the so-called surveillance mechanism, or multilateral surveillance. That is to say, the IMF plays here a central role in sort of overseeing how members are complying with these obligations. Now, surveillance means that the domestic economic and monetary policies, all policies that might have an impact on exchange rates, are then subject to the purview of the IMF. So the IMF has a droit de regard, the right to look into these policies, and that's what it does under the so-called decision on surveillance. So there are a number of economic developments that may be brought to discussion before the IMF. So the IMF becomes sort of this key forum for the discussion of domestic monetary and economic policies. And that is why the IMF plays a significant role in discussing whether or not the members' policies are conducive to international stability or not. Okay, so on the one hand, and I mentioned earlier in chapter 3 that because of this, the idea that domestic economic policies are essentially a matter of the reserved domestic domain, that other countries cannot dictate us which economic policies we pursue, or if we have a policy that is more generous on social rights or less generous, that there's no right on other members to sort of question those economic policies. This changes because since these policies may have an effect on exchange regimes, on the exchange rate, and thus on exchange regimes and on international trade, then this becomes part of something that may be discussed by the IMF. Now, the IMF does have this policy mandate, Article 4, Paragraph 3, Proviso B, that they have to respect the domestic, social, and political policies of members, and to pay due regard to the circumstances of members. So the IMF is not supposed to second-guess member states as to their policies. So you may have a discussion of economic policies, to sum up, saying that you should reduce your budget deficit, and even pointing to specific targets. But the IMF cannot direct a member to adopt specific economic policies. So each member has to decide which economic policies it pursues. Now, in order to sort of allow the IMF to perform this role, they conduct what is called Article 4 missions. And these are missions whereby staff of the fund visit the capital of a member. They have broad discussions with government officials, with stakeholders, business associations, trade associations, unions, etc. And then the result of these consultations is published on the IMF website. So it does evaluate the policies and indicate whether or not those policies may create problems for the international monetary and financial markets in the future. But what I wanted you to note here is this tension between the IMF having the duty to respect domestic policies on the one hand, and then its function as an evaluator, as an appraiser of these policies with regard to these broad international objectives. As we're going to see, Article 4 is of a global application, so it applies to all members, developed, developing, least developed. It applies to all members, but these obligations only gain sort of teeth. They only become really enforceable types of obligations when members ask for the fund's financial support. So only when you want to have access to the funds, then the IMF can impose conditions. You may only have access to these funds if you pursue certain economic policies or if you achieve certain economic policy goals. So this Article 4 applies to everyone, but then when you look at the effectiveness of this provision, it is only really very effective if you need access to the fund. So this creates this dichotomy between countries who need the fund, and then they're much more careful in order to make sure that the fund does not excessively criticize their economic policies, and members that do not plan to resort to the fund, and so they can just brush aside any concerns or criticisms made by the IMF. Plus, then there's the problem also of the sort of orthodoxy that is followed by the IMF. Okay, so the current framework for supervision is set out in this July 2012 decision on bilateral and multilateral surveillance. Because of the financial crisis in 2008, which showed that even with surveillance, the economic crisis sort of surprised most economic actors in the world, then they created a so-called integrated surveillance approach. So this looks not just at a specific country-by-country analysis, it also takes account of cross-country spillovers. The financial crisis of 2008 started in the US, but then very quickly it hit the rest of the world, particularly Europe, and the rest of financial markets. And so we cannot look simply in isolation at the US economy. We need to have this integrated surveillance to take into account the possible impact of events taking place in one or a few countries in the rest of the world. Again, in accordance with Article 4's mandate, as you can see here, domestic social and political policy objectives are beyond the decision, the scope of surveillance. Although, as you can see, so there's again the tension. So these are supposed to be outside the purview of the IMF, but members need to ensure that such policies are consistent with their Article 4 obligations, and they are encouraged to be mindful of the impact of such policies on the international monetary system. So, in other words, although members are free to adopt the social and political policy objectives that they wish to, which is important if in a democracy you vote for your government, because you have different, policy and social policies to choose from. And so it's important that there's an open public policy space, that that there's a diversity of public policies that may be then pursued in accordance with the wishes of the citizens. Now, because as you can see, you have to be mindful of the impact of a given political choice on the international monetary system, then the actual policy space is constrained indirectly by Article 4. So say you want to implement a very generous social policy. Well, you have to take into account, can you finance that? Is this going to imply that you'll have to raise taxes in the future? Will this lead to some disturbance in domestic financial markets that may spill over to other countries, etc., etc.? So there is a constraint. It's not a legal constraint, note, but it is a significant policy constraint on on the political space for defining these policy measures. Okay, so it does say that this is a best efforts type of obligation. So members are not compliant to adopt very specific economic policies, but they do have this best efforts obligation. Okay, so this is just a guide as to what comes under the heading of bilateral surveillance. So bilateral surveillance is surveillance, where the IMF goes to each of the members in turn, and they all get a review. The most important ones get a yearly or biannual review. Less important members will get probably a review every once in every 5 years or something like that. Now, what does the IMF look at? Well, here you can see the list. So systemic stability, is the financial system, the banking system, is it stable? Do you have a lot of, credit risks, etc.? The balance of payments stability, are you able to afford continuing to sustain your balance of payments? That's something that will not lead to the so-called disruptive exchange rate movements. Exchange rate policies are taken into account together with monetary, fiscal, and financial sector policies. Okay, and this is the minimum content. Now, when we talk about fiscal policies, this covers what in Portugal, for instance, when we speak of fiscal policies, we tend to think of tax revenue. That is to say, policies relating to the revenue side of the budget. Now, in English, fiscal policy is much broader, and it includes both the receipts of the side of taxation, together with spending. So when we talk about fiscal policy, we're also looking at spending, at public spending, and how that public spending is allocated. Are you going to try to reduce the level of public expenditure by privatizing firms, or on the opposite side, are you going to nationalize firms because you think that the state should have a higher role? All of this will have an impact on fiscal policy, and that comes under the surveillance of the IMF. Then other policies, are only subject to the extent that they may significantly influence the balance of payments or domestic stability. Because monetary unions, such as the Eurozone, have particular problems, then there's a specific approach to the economic policies in monetary unions. Okay, so that's bilateral surveillance. Multilateral surveillance obviously looks at the world from a more global perspective, and so it looks at the international monetary system as a whole. Okay, so those are the two types of surveillance that you have in Article 4. Okay, then there are a number of principles. These principles, only Principle 1, which, as I said, is still subject to hard law, to hard rules in the Articles of Agreement, is to avoid manipulation of exchange rates in order to gain an unfair competitive advantage. All the other principles are mere recommendations, and as I mentioned earlier, members have this sort of a soft law duty to, best efforts obligation to try to achieve these, to fulfill these principles. That members will intervene if there are very disruptive capital movements, for instance, in order to stabilize the exchange rate. That any policy to intervene must take into account the interests of other members. So it has to take into account the fact that exchange rate policies have an international dimension. They should avoid exchange rate policies that may result in balance of payments instability, and then to avoid domestic economic and financial policies that would give rise to domestic instability. Again, a non-sustainable state public deficit, public budget deficit might be one of these problems. So this, again, allows the IMF significant leeway into looking into domestic public policies. Now, looking here at principle D particularly, also has to do with the issue of devaluation, and it means that if you have a very sustainable trade surplus, this is going to have an impact in your currency. Theoretically, if you have a large surplus, then demand for your currency should go up, which means that your exchange rate, your exchange rate should also go up. That is, if China sells a lot of products to the U.S., it has a large surplus with the U.S., then the demand for the Chinese currency should go up, demand for dollars should go down, and thus the Chinese currency would become more value than the US dollar, thus making Chinese exports more expensive for US consumers. And this is basically the idea behind David Hume's insight into the balance of payments. Okay, so the more you export, the more there's demand for your currency. Then comparatively, there's more abundance of other currencies, which means that your currency's value will go up, and thus making your exports more expensive to your importing trading partners. Now, when you look at, say, U.S.-Chinese relations, but the U.S. under Trump also complained a lot about the EU, you see that both the EU and China have large trade surpluses with the United States. And this leads the United States to argue that you should let your currency revalue, its value to go up, so that your imports become more expensive in U.S. dollars, and that this will lower the trade deficit. So that's one of the issues where we have a clear interface between monetary and trade policy affairs. But we will look at that in more detail later on. Okay, this is just to complete things. You have on the slide a sort of more thorough review indicators. So what will the IMF look at in terms of bilateral discussions? Okay, so as to the multilateral payments regime, now payments have to do with payments for actual transactions. When you purchase a good or a service. And when we talk about payments, then payments here are quite clearly subject to very formal and clear rules. That if you have all these payments that relate to so-called current payments, payments for the current account, imports of goods and services, that they cannot be subject to any type of currency restrictions, of exchange restrictions. Now, this is other than capital movements. So capital movements are not covered by this obligation. Now, this obligation under Article 30, paragraph D, the definition of current transactions, includes not just the import and export of goods and services, but also payments of interest on loans, payments of amortization in order to reduce the amount owed, depreciation of direct investments, as well as moderate remittances for family living expenses. A lot of countries that have many immigrants, Portugal was and still is an example of that. A lot of the balance, the current account, really is heavily dependent on these remittances from residents that emigrated to other countries. So these are also covered by the obligation to eliminate any currency restrictions. So current payments are covered by a very liberal regime. Okay, so as you can see, Article 8, Paragraph 2, Proviso A, you cannot impose restrictions without the approval of the fund on payments and transfers for current international transactions. It is, however, allowed to have restrictions within transitional arrangements under Article 14, Paragraph 2. And so far, most members had accepted Article 8. When you accept Article 8, then you waive this Article 14. So, Article 8 really applies to the overwhelming majority of IMF members. Okay, then capital transfers. So transfers for, buying shares, etc. Well, they're subject to domestic controls. So members may impose domestic controls on capital movements. They can, limit the repatriation of these capital movements, as long as you can see, they do not exercise this power to restrict payments for current transactions. That is to say, they use these restrictions in a way that spills over to limit current transactions, or that they unduly delay transfers of funds in settlement of commitments, such as repayment of loans, etc. Okay, so another important rule with regard to exchange rates, and again, hard and fixed rules, so no soft law here, is the rule that prohibits discriminatory exchange rates. As I mentioned earlier, this is a reaction to the interwar policy of Nazi Germany, where they used these discriminatory currency practices for political purposes. And what does it mean? It means that you cannot have, for instance, different exchange rates for different current transactions. Say, you have a higher exchange rate, so one that limits imports for, say, luxury goods, and then you have a lower exchange rate for essential goods, or one for tourism and one for other types of services. It also means that you cannot discriminate between foreign currencies. So have one rate between, your currency, say the Brazilian real versus the dollar, and then a different exchange rate for real versus euro. Now, there is, however, the possibility to apply, and there's legal authority in that sense, to discriminate as to capital movements. Okay. For instance, you can have different exchange rates for short-term capital movements versus long-term capital movements. Now, long-term capital movements involve an investment, a long-term investment. So, that money is going to be in your economy for a long period. And, it means that foreign investors will open a factory, they will hire people, etc. And so, most countries will tend to welcome those investments. Short-term capital, on the other hand, seeks what it sounds. It seeks short-term profit. It wants to speculate on the share values, etc. So you might be interested in limiting, those sort of short-term, capital movements, because they tend to be very disruptive, particularly with regard to exchange rate regimes. There's a high demand, and then if they sell out, there's a high supply of your currency in international markets, and this will affect your exchange rate. And so you might have, very significant policy reasons to control these short-term capital movements. And in this particular case, as again, you might use discriminatory exchange rates, but again, only with regard to capital movements. So capital movements are not really subject to the central discipline of the IMF Articles of Agreement.